Hello, so this is topic number 3 for banking and financial institutions. The main topic is banks and banking perspectives. And then for the subtopics, we will be discussing historical perspective worldwide, Philippine banking history, Philippine banking today, principles of banking business, types of banks, and then we have the economic significance of banks and why the state supervises banks. Okay, so to show you the content, so first off, we have historical perspective worldwide. So I had a hard time finding a material to use in this subtopic. When you think about perspective, it's a point of view, how a certain concept is viewed, and I'm not about to discuss every sector's point of view towards banking, not to mention historical, from different time periods and then worldwide involving many countries. So let's make this simple, banks and banking perspective. What do people know about banks? Okay, so we're taking the point of view of the people, the ordinary people. Okay, so in the previous video lesson, we already had the history of banking, how central banks were developed over time, and the lessons they had over the years. We also had the brief history of Bangko Sentral ng Pilipinas. It's the official name now. It's like the given name, so we shouldn't translate it to Central Bank of the Philippines. It was called that before it became Bangko Sentral ng Pilipinas, and I think it was done for the sole purpose of staying true to our own language and fostering a sense of patriotism or nationality. I'm not sure. That's only what I think. Anyway, going back to perspective, people's understanding of banks. You have extra money or cash on you that you're not going to spend, that you're saving. Where do you put it? So do you prefer a piggy bank, put it between, the pages of a book? Do you have a safe at home, or would you trust the bank to take care of it for you? Okay, so it's not really an easy decision. There are a lot of factors to consider. Are you sure you won't be needing this money anytime soon? Would it be convenient for you to visit the bank whenever you want to make a deposit or when you make a withdrawal later on? Do you feel comfortable leaving your money with them? Are you assured that they would return your money when you need it later? When banks began operating, I'm sure people were reluctant and hesitant to give their money to them. The company is, this company is saying they'll be keeping our money safe, we'll earn a little interest, but what guarantee do we have? Okay, so these were the times. There are no banking laws yet. They do not answer to regulatory agencies yet. No insurance yet. No PDIC. If the company goes bankrupt, you lose the money as well. Okay, if a fraud is committed, some managers stole the money and run away, how are you going to get your money back? Okay, so all these questions, all these problems, they presented themselves over time. The government got involved. It involves money, after all. It also involves the general public. Must protect the citizens. Okay, so you can't let them lose their money and point fingers at you. Okay, so that's how the government viewed it. So if a crime is involved, the government must get involved to resolve the issues. Okay, it's part of their responsibilities to protect the interest of the public. So over time, with the supervision of government agencies, the passage of laws, we have rules and regulations now, the banking industry learned the lessons it needs. So far, anyway, because currently, they're still innovating, they're still providing new services, especially in, this digital age. Okay, so we now have regulations, we have insurance of deposits, we have supervisions, we have scrutiny of new products or services before they are launched on a large scale. So we have the so-called beta version, especially in digital products or apps. Okay, so let's break that one by one. Okay, insurance, PDIC, Philippine Deposit Insurance Commission. If you're a depositor to a member bank of PDIC, you get protection for up to 500,000 of your deposit. Okay, so translation, if you have a deposit of 350,000, you're insured up to that point. Okay, 350,000. In case the bank goes bankrupt and you can't get your money from them, then the PDIC will hopefully return to you a portion of your deposit or up to that amount of your deposit. Okay, so if you have, on the other hand, if you have a deposit of 1 million pesos, you're insured up to 500,000 pesos only. Okay, if you have more than 500 100,000, you'd rather put them in, different banks insured by PDIC. But if you have tons of money, so you'll most likely choose a bank with a reputation, with a long history of operations to assure yourself that you're not going to lose your money. Okay. So now, how did the other financial institutions came out? Okay. So basically, in the beginning, we have the banks. Okay. How did the other financial institutions came about? So the big banks, mostly classified as universal or commercial banks, are quite strict in their loan requirements. Before you can borrow money from them, you must present certain documents. Actually, before you become a depositor as well, you have to present certain documents. You have your IDs, your source of income. You have to have a TIN number or SSS number. Okay, and then in a way, as a depositor, what they wanted to ensure is that you have the ability to actually save, and that in a way you're committed to saving your money. Okay, but of course, it's a different matter for the borrowers. They are more strict with the documents that they are requiring. Okay, so with the economic composition of the Philippine population, a larger portion of the population falls under the poverty line. So we have the lower class and then the middle class. Okay, majority are in the lower class. Okay, normally the lower class could not borrow from banks. Okay, they don't have enough income or source of income to assure the banks that they could pay the loan. Okay, so they turn to thrift banks or rural banks. Okay, these types of banks cater to their needs. Okay, basically thrift banks and rural banks are banks on a smaller scale. They have smaller asset size. They operate on a smaller community, for probably municipality, the surrounding municipalities, or provincial level or regional level, but not at the national level. Okay. So again, we have the thrift banks or rural banks catering to the middle class and then larger portion of the lower class. Okay. But then, there are people who still can't borrow from thrift banks or rural banks. Okay, in a way, they also have their certain requirements, but it's definitely less strict than the universal or commercial banks. But still, they have requirements still. Okay, but then of course, not everyone can provide the requirements. Okay, you cannot provide the documents to prove that they are capable of paying off the loans. Okay, of course, these thrift banks and rural banks still has to protect themselves from possible, non-payment of loans. Okay, so what is the next recourse for people who can't borrow from thrift banks and rural banks? Okay, so they turn to pawn shops. If they have old jewelries once they inherited from their grandparents, or land titles that they also inherited from the older generation of their families. When they can't pay in cash, the pawn shop would sell the property. Okay, so this is usually done in auctions to the highest bidder. Okay, aside from pawn shops, we also have lending companies. They do evaluate your available collateral before approving your loan application. Okay, and then aside from that, we have the informal ones. Not legit in a sense that they aren't properly registered businesses, but operating like one. Okay, so we have 5-6 cash loan apps. This is what they call kapit sa patalim. Okay, because of very high interest rates. In banks, you have 12% annual rate, or it does not go far from that. Okay, it averages 12%. Okay, annual rate. That's 1% a month. Okay, in pawn shops, lending companies, and informal lenders, the rates could go as high as 3% a month or 5% a month, making that 36% in a year, or 5% times 12, 60% a year. So in very rare cases, there are also those who charge 5% a month in 3 months time. Normally they do this for short-term loans. Okay, so let's say 5% a month, but only for 90 days or 3 months. So that's a total of 15%. Okay, the adage high risk, high return play a role in that. You don't have a source of income, you don't have a good collateral, but we're taking a risk with you. Okay, there's a possibility that you may not be able to pay. So to offset that, we can only charge you with a higher rate of interest. Okay, the banks don't want to take this risk with you. That's why they aren't lending you money, but we are. Okay, but in exchange for this high risk, we must try to get a high return. Okay, so you get the idea. Then of course, with the advancement of technology, most businesses have gone online, and so banks and other financial institutions must also make their services available on the internet. Okay, they can have their own if they can have their own applications, why not? Okay, so what do this online presence provide? So we have convenience and then ease of access. Hey, I may not need to visit your branch after all. I can do most transactions online or through the application. Okay, fees and charges, most people would react with no problem as long as it's convenient. I don't mind paying. I'd rather do this at home instead of going out, lining up in a queue, spending hours there and getting tired. Okay, these are mostly targeted at the middle and upper class, but to the lower class, every cent counts. Okay, I've been to a point in my life where every cent does count. College days, review days. Anyway, on the other side, we have people with too much money. Deposits are earning them a small percentage, so they're looking for something else that could earn them more. Okay, in came investment houses, investments in general, forex trading. Engaging in these could make them more money, so compared to simply saving their money in the bank. Okay, so there you have it. That's the banking perspective, and then how it created other opportunities for other financial institutions. Okay, and then we have the Philippine banking history. Although we've already had this in the previous video, so we're not going to tackle this again. You can just watch the previous video again and refresh or review what we've discussed about the Philippine banking history. And then also we have Philippine banking today. Basically, we discussed the structure of the Philippine financial system. It's pretty much the same, okay, with regards to the banking. The banks compose the bigger portion of the financial system, okay, of the Philippines. Okay, so this has been covered in the previous video, and with regards to the different types of banks, we'll be discussing them later on, so we'd rather not have this here. Okay, in a way, it's kind of difficult to separate similar or related topics, but there you go. I will be covering them more in detail later on. Alright, so next we have principles of banking business. So I got this article from your article library. Okay, so banks follow the following principles of lending. So we have, first is the liquidity. Ano ba yung tinatawag natin na liquidity? So liquidity is an important principle of bank lending. Bank lend for short periods only because they lend public money, which can be withdrawn at any time by depositors. Yes, okay. So we have your depositors putting their money in the bank, and then the banks would lend this money to people who needs the money, the borrowers. Okay, the depositors they can withdraw their money anytime. Some people they leave their money in the banks for long periods of time, but there are also those who would withdraw their money anytime for emergencies or whatever. Okay. And so most banks, they do provide short-term loans to the borrowers. Okay, majority are in the form of short-term borrowings, and then also they have a portion for long-term borrowings. So they would allow borrowers to have it for 1 year, 2 years, 5 years, 10 years. Okay, but a larger portion would still be short-term loans. Okay, so that they could collect the money immediately from the borrowers, and then of course, in case the depositors would like their money back, they would have the cash on hand to give to the depositors who are withdrawing their money. So liquidity, okay, the availability of cash, the availability of the assets in the form of cash. Okay, let's say the banks lent the money to borrowers, all of it long term. Okay, so when the depositors came in, hey, I'd like to withdraw 100,000 from my bank account, and then the bank's like, oh, we've lent all your money to the borrowers, we don't have it right now. Okay, so that is a no-no with regards to the regulations. We have the banking laws. They require banks to retain a certain portion of their capital or resources. I think it's currently at 10% or 20%, something like that. You have to retain that much cash in your bank so that these depositors, a portion of them would like to withdraw their money, then you can provide it to them. Okay, so basically that's the liquidity, the availability of cash available just in case the depositors would like to withdraw their money. Okay. A bank chooses such securities in its investment portfolio which possess sufficient liquidity and is essential because if the bank needs cash to meet the urgent requirements of its customers, it should be in a position to sell some of the securities at a very short notice. Okay, let's discuss this as well. So the bank's majority of their products or services are loans. Okay, but of course, let's say you have 100 million. Okay. Let's say 50 million are short-term loans, 20 million are long-term loans. There's still a portion of there that they retain in their company, and then a certain portion still is being put in investments. Okay, I'll discuss that later. Okay, so investments, depending on the plans of a certain bank, they normally apportion their resources, and they have limits. Okay, how much can we put into short-term borrowings, how much can we put into long-term borrowings, how much should we invest, and then how much should we retain. On the portion of how much should we invest, they have a breakdown still limit. How much should we put in long-term investments, and then how much should we put into short-term investments. Okay, in normal cases, the short-term borrowings and the short-term investments are normally a bigger portion than the long-term ones because they have to ensure liquidity of their resources. Okay. Bonds. All right. The shares and debentures of large industrial concerns also fall into this category, but the shares and debentures of ordinary firms are not easily marketable without bringing down their market prices, so the banks should make investments in government securities and shares and debentures of reputed industrial houses. Normally, stock, since we have the stock exchange, it's easily convertible into cash. And then with regards to bonds, there is an existing market, but normally it's smaller compared to the stock market because they don't have that online presence. If you want to invest in bonds, you have to go to other banks or to investment houses. Okay, so it's another thing. Second principle is safety. The safety of funds lent is another principle of lending. Before borrowers can borrow money from banks or other financial institutions, really, they have to assess the capability of the borrower. Okay, do you have your source of funds? The amount that you're going to borrow, is it something that you can pay off for a certain period of time? You're borrowing 1 million for 5 years, but you're only earning 10,000 a month. Do you think you can repay this in that amount, in that period of time, with this much amortization per month? Okay, so before they can, approve applications for loans, they have to scrutinize, evaluate, assess certain factors. Okay, we'll be discussing this later on again, specifically with regards na dun sa types of banks, okay, and how they do their operations, how they conduct their operations. Okay, so in a way, they have to ensure the safety of the funds. They would not, in a way, lend this money to someone who may not be capable of paying it back. Okay, in that case, it's going to be a loss, and they could not allow the money to be lost. Okay, that money, basically, on the part of banks, it's their liabilities because the funds came from depositors. The owners of the funds are really the depositors, okay, not the bank. So they are just like a middleman of some sort. So they have to ensure they have a liability to return that money to the depositor. So they have to ensure that this money they're lending the borrowers would also be returned to them. Okay, so they have to assess the risk. Okay, if the borrower is a businessman or someone with, a startup, a small business, and they wanted to expand, you have to ensure first that their current business is profitable, it has the future, it's really possible for them to expand, to grow their business because the demand is there. Okay, so these are some of the things that should be checked by the banks or the financial institution. All right, and then it's the same principle with regards to investing in stocks or bonds, government treasuries. Okay. Third principle is diversity. In choosing its investment portfolio, a commercial bank should follow the principle of diversity. Okay, diversity is another principle in investment as well. Okay, you're not going to put all your resources in just one place. Okay, you have to diversify so that the different risks would offset each other. Okay, even you put your money in different investments. If one investment fails, okay, you have other investments that may or may not be profitable. Okay, so the profit would offset the loss that you have in one of your investments. Okay, unlike you put all your investments here, it's profitable, that's good, but if it becomes a loss, then that's bad, then that's all your money there. Okay, so you don't want to suffer all the loss from that one investment. So that's why you have to diversify, put your money into different places. In investment, what we've discussed in in portfolio management, you put some money in stocks, you put some money in banks, you put some money in different industries. Okay, you're not going to decide on put your money in just one company or in different companies, but they're all in the same industry. Okay, if you put your money in different companies but they're all in the same industry, as the economy affects certain industry the same way. Okay, so you have to diversify in the sense that different companies from different industries with different scale of operations. Some of them are on a national level, some of them are specializing in certain regions only. Okay, so you have that to consider to diversify your investments or your investment portfolio. Okay. Then keep all your eggs in one basket. That's how you offset the risk and return. Okay. Next, we have stability. Another important principle of a bank's investment policy should be to invest in those stocks and securities which possess a high degree of stability in their prices. Okay. So you have your new companies or new industries that in a sense, you don't know how it's going to perform yet in the long run. Okay, but on the side, you have these companies who have been operating for decades. Some of them have been operating for a century already. Okay, so in a way, you're assured that these guys have survived in so long. They've been able to come this far. So in a way, you'd think that they are stable already, unless something else happens, or unless just like ABS-CBN, in a way their operation is tied to the approval of the Congress. So that's one thing. And then of course you have these banks, BDO and BPI, who've been operating in so long. You'd like to think that they're very stable and that their regulation is only with BSP, okay, SEC. Okay, so it would be much easier for them to survive in the long run as long as they comply with the laws, with the rules and regulations. Okay, so there is that. Okay, and then with regards to bonds and stocks, so that's how you choose companies with stability, with a long history. And then government bonds, of course, the government itself is a very stable entity because it's being supported by the people. So you wouldn't think the government of the Philippines would go bankrupt, because as long as there are people who are paying their taxes, as long as the economy is ongoing, there's exchange, sale of goods and services, then it would go on. Okay, so although government bonds, it's some sort of a sure investment, so the interest rates are lower. Okay, the return is much lower, but at least it's assured. Okay? It's a sure return naman. Okay? So that kind of upsets it. Lastly, we have profitability. So this is the cardinal principle for making investment by a bank. It must earn sufficient profits. Okay, it should therefore invest in such securities which was sure of fair and stable return on the funds invested. The earning capacity of securities and shares depends upon the interest rate and the dividend rate and tax benefits they carry. Okay, if you're on stock trading, you can see this information on the financial reports provided on the companies that are listed in the Philippine Stock Exchange. Makikita mo naman doon yung mga ratios, profit ratios, price to earning ratios, dividend history. You can see this there. Okay, and then of course they provide the last 5-year financial report so that you'll see how much have they been earning in the last 5 years. Are they always profitable? Did they suffer a loss in the last 5 years? Something like that. Okay, so you can see this information. And for the banks and financial institutions, before they put their money in these certain investments or certain activities, then they of course have to evaluate as well the financial reports of those places where they are planning to put their money into. Okay, and then we have the types of banks. So in this module, we will be discussing universal banks, commercial banks, thrift banks, rural banks, and then offshore banks. Okay, so we will be discussing each of these in the coming video. So in this video, I'm only going to give you an overview about these types of banks. Okay, so they are normally differentiated by their asset size or capitalization, as well as the products and services that they are allowed to offer to the public and the scale of their business. So this is in accordance with the banking regulations. Okay, these are arranged the list. Okay, this one from the largest type of bank to the smallest, with the exemption of the offshore banks. Although essentially the offshore banks are small scale, since they are offshore banks. Later we'll be discussing that. Normally, universal and commercial banks operate on a national level. They're everywhere in the country. You have BDO, Metrobank, BPI. Okay, thrift banks and rural banks, they operate on a much smaller scale, either in their own municipality, including the surrounding or neighboring municipalities. Some operate on a provincial level or regional level, but definitely not national. Okay, in the case of offshore banks, so these are essentially foreign banks that have a branch in the country. So when you deposit with them, it's possible that your money would be lent to people in their home country. So your money gets taken offshore, out of the country. So they are usually regulated under international banking license. So this is advantageous if you're usually traveling in various countries. Offshore banking makes it easier for you to access your money. And then on the other hand, these are usually used to hide undeclared income. Okay, so we'll talk about that in more detail when we specifically discuss offshore banks. Okay, next subtopic, we have economic significance of banks. Okay, this is an article from economicsdiscussion.net. So the banking system plays an important role in the modern economic world. Banks collect the savings of the individuals and then lend them out to business people and manufacturers. Bank loans facilitate commerce. Okay, manufacturers borrow money from banks, the money needed for the purchase of raw materials and to meet other requirements such as working capital. It is safe to keep money in banks. Interest is also earned thereby, thus the desire to save is stimulated and the volume of saving increases. The savings can be utilized to produce new capital assets. Thus, the banks play an important role in the creation of new capital or capital formation in a country and thus help the growth process. Okay, so first off, what's been mentioned is that we have people here who have extra cash. They save their money into the banks in exchange for a small amount of interest. And then on the other hand, we have the borrowers. Okay, with regards to the borrowers, we can break them down into individuals, salaried individuals who need them for short-term needs. Okay, and then we have, on the other hand, business-minded people, businessmen or existing business owners who'd like to expand their businesses. Okay, would like to buy machineries, equipment, or to put up a new branch in a different municipality or a different place, or a business would like to introduce a new product. They already have the prototype or something that they'd like to mass produce or something. So those are mainly with regards to the economy. What would help more in the growth of the economy, the development of the economy, would be those people, those types of borrowers. They have these business ideas, product ideas, but they need the money to be able to produce them. Okay, and so they turn to banks or financial institutions to get the capitalization that they need. Okay, and so in that regard, we're helping these businesses, these people, to continue with their business operations, to expand, to enlarge their business. And so on their part, they're producing the products. They're also helping with the employment rate because they would be needing people to do the business. Okay, when they expand, they would need more people, they would hire more people. Okay, so in a way, that helps with the economic side of things. Okay, continuing on, banks arrange for the sale of shares and debentures. Thus, business houses and manufacturers can get fixed capital with the aid of banks. There are banks known as industrial banks, which assist the formation of new companies and new industrial enterprises and give long-term loans to manufacturers. Okay, here's the deal. If you're a new business person and you have this business idea, most likely than not, you're going to be denied when you ask banks or financial institutions for loans. So who are these banks catering to? So mostly if you're a businessman with a known track record, with a history of putting up a business, and you are simply putting up a new business on top of other existing business that you already have. Okay, kumbaga, the banks, when they evaluate your capability, they would have that to base your capability on. Okay, you have already put up a business on your own prior to this, and your current business is operating well, is profitable, the operations are smooth, been able to manage it properly these last few years. Okay, so now you have this new idea, new product idea, and you want to put up a new business. So if that is the type of borrower that you are, then you are most likely going to be approved by banks or financial institutions. Okay, so that's how it is. So basically, you're not going to go to the bank with your startup idea and think or hope that they're going to approve your business loan. Basically, you don't have a proven record yet, so most likely than not, you're going to be declined. Okay, so basically, I'm just trying to make it clear. Okay, you might be hopeful. Okay, you have your business idea, you go to banks, and then suddenly you get denied because you don't have that proven track record yet. Okay, so just a thought. All right. And then the banking system can create money. When business expands, more money is needed for exchange transactions. But then again, this is controlled by the central bank. Okay, the central bank, the BSP, can create money, but again, this would depend on the backing that the country has, normally based on the gold standard. The legal tender money of the country cannot usually be expanded quickly. Okay, bank money can be increased quickly and used when there is a need of more money. So in a developing country, banks play an important part as supplier of money. Depends on the current economic situation. If it needs the infusion of money, then the central bank would put out the money that it needs. Okay, but if there's no need, okay, then they're not going to do it. The banking system facilitates internal and international trade. A large part of trade is done on credit. Banks provide references and guarantees on behalf of their customers, on the basis of which sellers can supply goods on credit. Okay. I think with regards to international trade, this refers to the import and export transactions. That if you're transacting with a company from another country, of course, you have to prove that you have the money to pay them before they send in the goods. Okay, so again, the banks can provide references, or this is some sort of bank certificate or deposit certificate that yes, this person has a deposit in our banks and this is the amount, and the other party would check, oh, okay, so you have enough money to pay us when we send the goods to you. Okay, so can you pay us with a down payment, and then the rest would be, some sort of installment scheme, maybe. Okay, if they're not going to pay in cash or in full amount. Okay, so this is particularly important in international trade when the parties reside in different countries and are very often unknown to one another, right? Trade is also assisted by the grant of loans, by discounting bills of exchange, and in other ways. Foreign exchange transactions, the exchange of one currency for another, are also done through banks. Okay, so one country to another, so there's foreign exchange involved, from peso to US dollars or from peso to another currency. Okay, so that would also be facilitated through banks, because banks also provide that service, the exchange transactions. Finally, banks act as advisors, counselors, and agents of business and industrial organizations. They help the development of trade and industry. Depending on, I think these are what we call some sort of BIP customers. Okay, if the bank is lending a lot of money, a large sum of money to a certain business, then in a way, somehow they require that a personnel of the bank would be some sort of representative, and that in a way they would listen in on meetings. Okay, what are your plans for your operations? Let this person, the bank representative, hear of it, so that they would know or assess if you're doing things right, or if there's something wrong with it, he can speak up and make recommendations, put out some advice, or give you some sort of guidance on how to spend the money and how you can use it to earn more. Okay, so they do act as advisors, counselors, or agents of business. Okay, but of course not everyone would have that person. Normally they only give that out, or they provide that extra service for borrowers who they've given large sums of money, especially if they assess that, oh, okay, this project is good, this business idea is good, this business model is good, we'd like to help you out, we're going to give you the funding that you need. But of course, to protect themselves, they're going to have to let this person, the banking person, listen to all your ideas, monitor your operations, so that we'll be assured that the money will be used as you presented in your proposal or in your loan application. Okay, so that's that. So there are special types of banks which provide facilities to different kinds of economic activities. Nowadays, in every country, there is a central bank which controls the activities of all other banks, endeavors to keep the price level steady, and controls the rates of foreign exchange. Normally, the BSP do give out some sort of digest or reports telling the public, as well as the other banks, the banks that are under them, which industries are most likely going to perform well in the coming year or years, which industries are probably not going to do well. Okay, so in a way, they provide guidance to the banks, which industries you should prioritize. Okay, so if this person comes in and the industry is planning to work on is on the list of thriving industries, then sure, go ahead, help him out, approve the loan if he meets all the requirements. But if a person comes in and he's working in an industry that's not performing well, or the PSP projects not going to do well in the coming years because of the current situation, economic situation, pandemic situation, or other factors, so more likely than not, the bank may not approve the loan. Okay, because you're in an industry that's performing badly this trying time, so your loan application may not be approved at this moment. Okay, so there are those types of services or guidance that the central bank is providing. Okay, last part of this video, why the state supervises banks. So here's the short version. I got this from slideshare.net. The banks are entrusted with other people's money, of course, so to protect the interests of the people, since the people are supporting the government must protect them in exchange. Okay, that's one of the reasons. And then the state wants to ensure that the banks will perform their functions in the best interest of their clients through honest and efficient conduct of their functions. Okay, that's another. Parang ano lang, business regulation. Okay, you are saying that you're going to provide a service, then make sure that you are providing that kind of service. Okay, and don't do anything else that's not within your the regulations, within the rules. Okay. Number 3, the banks may either abuse their power or use them prudently. Okay. I did a quick research before about the 2008 financial crisis, and the main cause of it is the regulation. The banks were allowed to do what they want, and some of their decisions, operations were seen to be detrimental to the benefit or to the interest of the general public. Okay, so in a way, in the short term, their actions or their activities would seem to be profitable for them, but in the long run, they are detrimental to the economy as a whole, to the industry as a whole. So in a way, after that, another blunder in 2008. So the banks were once again regulated by the government. Okay? And then we have number 4, the banks are quasi-public corporations, and as in all other corporations of this calling, since they're dealing with public, the state must exert its restraining influence to safeguard the welfare of its constituents, the public, okay, the citizens, the residents of the country. Alright, and then here's another article about why the banks must be supervised by the state. Thismatter.com. Let's read a bit of it. Banks are an essential component of any modern economy. Of course, they play the role of the middleman, where those people with money put their money in them, and then those who don't have the money but they need them to do their thing or to expand their businesses would go to the banks to get the money or the capitalization. They provide an easy way for people to save money, and they provide payment services primarily in the form of checks, electronic fund transfers, credit and debit cards. Okay, makes it easier for the depositors as well to pay their bills. And then without payment services, the economy would quickly come to a halt, of course. In the beginning, when there's only checks, no digital payments yet, of course, the checks provides a convenience in such that you don't need to carry 1,000,000 pesos if you're going to buy a piece of land. You just bring your checkbook with you, write the amount there, and then let the seller in cash the check at the bank. Okay, so it serves as a form of payment that's convenient to the depositors or the public. But with the digital payments nowadays, just fund transfers, electronic fund transfers, and then you have the use as well of credit cards or debit cards if you're going to have online payments. Okay. Without payment services, the economy would quickly come to a halt. Of course, there should be a method, a way, a means to exchange payments. Okay. Well, when you buy goods and services, so there should be a payment method available. Banks are also highly leveraged. Most of them have liabilities that are at least 10 times their bank capital. So even small losses can wipe out the bank's capital. Here in the Philippines, the norm is that the capitalization, of the owners is 10%, and then 90% are liabilities. Okay, these liabilities, these are the deposits from the public. Okay, so that is the norm with regards to the financial structure of banks here in the country. Again, 10% capitalization from the owners, and then 90% are liabilities representing all the deposits made by the general public. Okay, so that's why it's important then for them to, operate well, ensure that the capitalization is maintained, okay, and it's not eaten up, because as soon as that's eaten up, then the liabilities will be next. Okay, later I'll do a discussion showing you the financial reports of the different banks. Okay, Furthermore, the use of leverage is achieved by using other people's money, deposits, loans, and stockholders' equity, which creates the moral hazard inherent in risking other people's money for one's own profit. Okay. When large banks fail, they can pose a substantial risk to the financial system, of course, of any economy because banks are highly leveraged. Imagine a large bank wherein, let's say, around 20% of the population deposited their money in there. When they fail, it's going to affect a lot of people. And then on the part of the businesses, it's also going to affect them because they would have one less extra source of capitalization in case they have their banking, their loan applications in there. Okay, if it doesn't go through, then their business would be affected as well. And then when the businesses are affected, the employees are affected. When the employees are affected, their families are affected. When the families affected, the whole economy can collapse. Okay. Because banks are highly leveraged, 90% came from people, from the public, represents the liability. Large loan losses may cause instability in the financial system. If a large bank fails, then the loans that it has acquired from other banks may cause those banks to fail also. Okay. In terms of the banks, okay, so you have the thrift banks and rural banks. They are actually depositing some of their money into the commercial and universal banks. And then these commercial banks and universal banks, sometimes they do provide deposits to each other, and majority gets deposited to the Bangko Sentral ng Pilipinas. So, in a way, they're also having transactions among each other, and that the system is, they're all connected. So if one of them fails, the others might be affected, especially the top one, okay, the universal and the commercial banks, since some of the thrift banks and the rural banks are also depositing their money into their company. Okay, so in such a sense, large banks' losses may be affecting other banks, which can cause many of those banks to fail, since they often rely on loans from other banks to cover shortfalls. Such was the case during the Great Recession of 2008 to 2009, so basically the 2008 financial crisis. In that recession, banks were failing because many of them were holding mortgage-backed securities, which were based on the mortgages of some subprime borrowers. Because many banks were holding these MBSs, credit dried up because banks could not know the financial viability of other banks, so they would not lend to them. Moreover, when banks fail, depositors lose faith in the system and start withdrawing their money, of course. And so withdrawing money, they would have to produce the cash that these customers have to withdraw, right? Okay. So leading to another cascading effect where more banks fail, one after the other. Thus, governments must prevent the failure of big banks by bailing them out. And how could they bail them out? So that's why, in a sense, the government, the state, must regularize or must supervise these banks, because in case of a very dire situation, the government must prevent the failure. They must help them out, and in a sense, how can you help them out if you were not helping them from the very beginning? How can you shoulder all the responsibilities? So that's why from the very beginning, the government must supervise the banks, so that in a way, kumbaga, prevention is better than cure. From the very beginning, they're being supervised, their activities are assessed to ensure that these are not going to cause problems later on. Okay, and so where are we? Which is why these banks are considered too big to fail. But by helping too big to fail, bank managers have an incentive to offer riskier loans or undertake riskier investments to potentially increase profits for the bank's owners or increase bonuses for its managers, since the owners and managers expect that the government will bail them out if their bets do not pay off. So this is a very conflicting scenario. We've had several examples of this, wherein the management of the banks they have their own self-interest, okay? They want the company, the banks, to profit, because that would mean bonuses for them, for the shareholders, for the owners, and bonuses for the management itself. So basically they're getting the money, okay? They're getting the benefits if their new products or their new activities pay off. But if not, they're getting into riskier situations. They're trying new investments, okay? That's what they did in 2008, okay? They invested in very risky investments, and they also do away with the assessment, the stricter requirements before lending out the money or before putting investments in certain places. They did not make very strict assessments, or they did not, what do you call this? They did not exact strict requirements, okay? So that's why when it did not pay off, the borrowers could not pay, the investments could not be turned into cash because they've been put into real estate. So anyway, that's how they caused a lot of problems back in 2008, and because of that, the government really realized that nope, we can't let you do your own thing. We're definitely going to have to regularize the banking system, the banking industry, okay? So they benefit from the symmetric information because they have greater knowledge of the riskiness of their loans and other assets than bank regulators have. Hence, governments have vested interest to prevent the failure of the banks, which is achieved partly by limiting the amount of risk that the banks may acquire, which is through regulation. While deposit insurance protects depositors against losses, that's why we have the PDIC. It doesn't prevent bank failures, which can still have a devastating effect on the economy, but it does guarantee that on the part of the depositors, they are somewhat assured that even if the banks fail, they can still get their money from the PDIC, okay? The government tries to prevent bank failures and losses to depositors by strictly regulating the financial system and by close supervision and detailed bank examinations. That's why, the BSP and the SEC requires annual reporting. If they are listed in the PSE, Philippine Stock Exchange, they are also required to submit quarterly reports, actually. Okay, banks are required to maintain deposit insurance, minimum capital requirements. They cannot lend every money they have to borrowers, or they cannot put everything in investments. They have to maintain a certain level of capital. I think it's 10 to 20 or 30%. And then to restrict their holdings to less riskier assets such as government bonds. Moreover, banks must adhere to standard accounting procedures and disclose certain information that may affect their viability. Basically, they're required to follow the accounting standards as well. So these are other materials for reading if you want to read more and you have time to spare. So you can check out these, these links, these articles. I'll be providing the document again in the description, Alright, so that's it for this video. We've discussed the banks and banking perspectives. In the next one, we'll be discussing the government banking institutions. So that's it. Thanks and bye.